So is the cavalry coming to save the day? The inflation is running out of control at 7.9%, one of the highest increases in history. Is the Federal Reserve going to save the day? The answer is probably not. They're going to raise interest rates another 6 times this year, trying to curb inflation. But what you don't know is they're probably actually raising interest rates because they know they're going to fail at trying to stop this inflation monster. And that failure is going to result in a recession, and it's all by design. So let's look at the accounting. Inflation's almost 8% and climbing. Gas prices are up 38%. Your housing is at about 4.7% increased over last year. Food prices are out of control, and they call all of this the inflationary problem. Well, what do you expect is going to happen when you put $5 trillion into circulation, you pump up financial assets, you drive up the price of housing, food shortages all over the place because of sanctions, and you got a war going on? Duh. Of course you're going to be in inflation, but inflation is a tricky game because the cavalry, commonly known as the Federal Reserve, can't save you this time because their normal actions, which we're going to talk about, raising interest rates, unwinding the balance sheet, have a hidden message. You got to look between the lines, folks. There's not a black and a white picture here. There's a gray area you need to see. And that gray area is the fact that the Fed already knows they can't pull this off. The Fed already knows that all these actions are going to drive the economy into a recession. So the reason they're raising all these interest rates so fast is because it's a race against time. And the time is how long do we have before it all falls apart, before we start heading to a recession. And the Fed only has one major lever that they pull when we start going down that other side into the deep, dark depths of a recession. And that's interest rates. But if interest rates are close to zero, can the Fed drop them to stimulate the economy like they did during the pandemic, like they did during 2008, like they did every other recessionary period? The answer is no. So are they really trying to come in and be the cavalry and save the day from inflation, or are they just trying to get interest rates higher so they can pull the lever when we actually end in a recession, which to me is where we're headed? So we're always talking about what's happening right now, but really what you need to plan for is what's next. All these numbers and statistics point to one place: what's coming. Well, if you want to know more, make sure you subscribe to this channel, click the alerts button so you're notified every time, and that's how you're going to be in the know for what's next. Let's get back into the video. Not only do you have inflation running out of control, you also have the Fed taking another action which many of you probably don't understand, and it is called unwinding the balance sheet. You see, when the Fed prints all this money, i.e. for 2008, the Great Recession, to save it, which they needed to, but then they kept printing. And then the pandemic provided the perfect opportunity for them to print a crazy amount of money, more money by double or more than they printed to save the Great Recession. Which, just so you all know, the Great Recession of 2008 was literally the closest we've ever come to a complete and utter failure in the financial markets. But the average person doesn't know this. They just think,
it was pretty bad. But we've forgotten about that because we've had over a decade of strong market performance.
When the pandemic happened, the Fed printed $5 trillion plus. They traded that $5 trillion that they printed out of thin air, which made your dollars weaker. They traded that with the US government for bonds, IOUs, called treasury bonds. They said, all right, here's $5 trillion, boom, and we'll trade it for treasury bonds. And then when they got their balance sheet up to around $9 trillion in these bonds, also they have some mortgage-backed securities in there as well, but we're not going to go there. They decided now, because of inflation and other things, it's time to thin out the balance sheet and start selling or maturing some of these bonds. Well, folks, this has happened before in history, and every other time except for one time, it has resulted in a recession. Now, I don't mean one time it's resulted in recession. I mean one time out of all the other times they've done it, it hasn't resulted in a recession. So what are the chances of the Fed pulling this off? I say 0. And I'm not the only one. Lots of people are saying there's a 0% chance that the Fed is going to pull off a soft landing. You see, I think they're smart enough to know that they can't pull off a soft landing. So I think what they're doing is going to plan B, which is let's get this ready for a recession. Let's drive the economy into a recession, and that's going to result in something we all know too well called stagflation. Matter of fact, I'm not the one saying that. Let me read you what they said in CNBC. Indeed, there are a lot of moving parts, and policymakers' biggest fear is that in tampering down inflation, they're going to bring the rest of the economy down at the same time. And then it goes on to say they're going to need a little bit of luck. I don't believe in luck, do you? They're going to need a little bit of luck, and if they get it, I think they're going to be able to pull it off. If they're unable to keep inflation expectations tethered, then no. We're going into stagflation scenario, and they're going to need to pull the economy into a recession right there on CNBC. So all of this being said, what does this mean for you? Well, it means you should probably start getting ready. If we know that there's a storm coming, heck, it almost looks like our cavalry, the Fed, is going to create the storm for us by raising rates 7 times in 2022, by unwinding the balance sheet. And right there, CNBC says this: the Fed officially plans to shrink the balance sheet by $95 billion a month. That's what the minutes say, folks. $95 billion. So they print $5 trillion, they exchange it for bonds, then they decide because of inflation and because of the economy's too overheated, we're going to sell those bonds and we're going to literally suck some of that $5 trillion back out to the tune of $95 billion a month. What do you think that's going to do? It's going to drive us into a recession. All right, folks, it's time to get serious and it's time to get to work, because did you hear what the Fed just said in their last meeting? Did you pay attention? Where are interest rates right now? They're really low, aren't they? And they're really low, and you know this because you probably refinanced your house. You probably took a home equity line. You probably bought a car, used your credit cards, everything else. It's all credit. And credit is controlled by the Fed, the central banks. Where are interest rates? They're almost zero. Some people don't quite understand why the Fed dropped interest rates. Well, when the pandemic hit and the whole market tanked, the Fed had to stimulate the market. It was a great excuse to print a whole bunch of money to devalue the dollar.
That doesn't sound good.
Well, let me tell you why they do this. So in dropping the interest rates, that gave everybody the excuse to go out and spend more money, which then hockey sticked everything. Do you remember what happened when the pandemic hit and everybody was locked down and companies were shut down and the markets were free falling and everybody thought, oh my God, the world's ending? Didn't end, did it? Nope. It quickly rebounded and it created this nice little hockey stick. You guys ever see a hockey stick? You know, the end of the stick kind of does this. Well, that's exactly what the markets did. That's what your stocks are doing. That's what your real estate did. It's all one giant hockey stick.
Like the sound of that.
But nobody really pays attention as to why.
Oh, it's the demand. There's so many people that want to buy my house.
But why is there so much demand? It's because cheap money drives demand. When the Fed dropped interest rates, it stimulated the economy. It stimulated you spending money. It gave birth to a whole new reset. But this wasn't the Great Reset. This was just the start. And in doing that, the Fed did another thing. What did they do? They printed trillions of dollars. How much? Well, no one will ever really know, but about $5 trillion were printed.
How is that possible?
Who printed that money? The central banks, the Fed. And then how did that money get back in your hands in the form of stimulus checks, PPP, EDIL? Well, the government, the US government that is, exchanged paper called IOUs, commonly known as treasury bills and bonds, to the central bank. And the central bank then gave them cash, printed money, this stuff. It's worthless, really, it's fiat money. But they said, okay, in exchange for the debt, here's the money. And they gave the government the money. And what did the government do with the money? He said,
here's a little for you, here's a little for you. The pharmaceutical companies get a couple billion. Here's a big stack for the banks.
Everybody got their little piece. All that money exchange and that debt that was created drove the economy to where it's at today. So after that one, we went into what we just witnessed is the COVID pandemic. Higher unemployment numbers than what you saw, the government printed $5.1 trillion, reduced interest rates to zero, pretty close to zero. The real rates were negatives. And all the things that you just saw happening all began right there. So the government printed $1.5 trillion during 2008, another $5.1 trillion during the pandemic, and now here we are today. So the real question comes to be is, what's next? Like, and what do we do? All I did that for, and I missed a lot of the details, and I apologize, but the reason I went through that is just to show you the similarities. Fed raising rates, Fed unwinding the balance sheet, which I didn't really get too deep into, but there was several periods where the Fed was starting to sell off some of the bonds that they had basically acquired by trading dollars for bonds, because that's all it is. It's that the U.S. government needs the money for the stimulus packages and everything else. The Fed and the Treasury prints the money, the Fed controls the supply, and they exchange the dollars printed at the Treasury with the U.S. government for U.S. government debt, called Treasury bonds. And that's why right now, to date, they have, God, what do they got? 9.8, probably, it's tremendous. It's almost $10 trillion in debt they hold on their balance sheet. They're going to start unwinding $95 billion. Just so you know, if interest rates don't crash the economy, that certainly will. So today is what, June 1st. We're all going to enjoy probably the last summer before we enter some really dark times. Dark times that could resemble the Great Depression or any one of those recessionary periods, or a combination and a mix-up, a mashup of all of them. And the reason this thing's going to be so bad is because we have literally had a government and the Fed kick the can for so long, print money under this new modern monetary theory of economics, and literally think that they can change the dynamics of what's going to happen. And hey, so far it's worked. So a lot of people are like, well, can't they do it again? Well, I think their actions are showing they're not going to.
And the beautiful thing about what we do now is we can meet somebody that's coming close to retirement, or maybe they're planning, they're 10, 15 years out. They don't have to drastically change their lifestyle now or their retirement goals. They just need to change one thing and not work any harder, not do anything different, just reroute where that money goes first, and then reroute what they're doing with that money and keeping that money moving for them, getting that lazy money they never even knew existed, that lazy things like equity in a home, things like that, get that money out there in a new investment. So this is real world stuff. I just want to reiterate that this is not just, things we read in books. Although Chris is absolutely right, we know what we're talking about because we study history, we study economists from books, but this is also real world applications. And what Chris is asking about, the things that really, the headwinds that really stop people from achieving these goals. I mean, is really, we call it the three enemies of stopping wealth. And number one is, just inflation. Number two, we're looking at taxes, and number three is, what am I trying to say here?
Well, you got inflation, you got taxes, and what's the third headwind? There's actually a lot more headwinds than just that.
Right, I'm trying to see what we're going to be going at today, though.
Because we got a lot of stuff to cover, but like those are two really big ones. I mean, market risk, interest rate risk, those are headwinds. I mean, There's lots of big headwinds.
Yeah, I was just trying to see. I mean, there's so many things that can happen. And I mean, when we start talking about, markets going up and down and riding it out, I mean, we'll get into this today too, like how that just doesn't actually make sense. Buy low, sell, buy low, sell high, and don't lose money. Like, why ride that thing out when we know what's coming? Like, let's get ready for that right now. And let's eliminate these headwinds. Let's prepare ourselves. And that's how we're going to create success moving forward.
Absolutely. So here's the thing, folks. The headwinds that you're facing, just like the board shows, and I think, can you guys see this board okay? You can see my little drawings of this guy that says risk. Stephen, can you see that, or should I zoom in a little bit closer?
Yeah, no, it looks good. It looks good.
Okay,
yeah.
great.
Yeah.
Mine, it looks really small. So right here, some of the risks that you're facing are number one.
The word I was looking for was volatility, just so you know, volatility.
Yeah, and that's exactly what I'm going to hit number one. Yep.
That's the market, right?
That's why I said market risk, volatility.
Yes.
Headwinds. Markets are experiencing a huge run up. Why are the markets going crazy right now? Has anyone ever thought about that? There's several components, and I want to help you understand maybe some things that aren't applicable, but just so you understand why this is happening this way. So why are the markets rallying? Well, last year the markets crashed, right? We had a 35% crash when COVID hit. In February, the market started trailing down, and they didn't stop for about a month and a half after, until they found the bottom. That resulted in a catastrophic 35% loss. So when people lost money last year and it started coming back up, they're like, I thought it was going to be a bad one. I thought that was going to be a doozy, but people were scared when that thing was going down. But what people don't understand is that was catastrophic. A 35% loss. Folks, all of you, think about last year. This is just a year ago, folks. We're only in April right now. Last year in April, we were in the peak moments of COVID when the market was collapsing. Businesses were shut down. America and the world was shut down. This is only a year ago, folks. 35% is what you lost. So if you lost, let's just say 10%. Let's say you had a diversified portfolio in your retirement account, your investments only lost 10%. Not a big deal. Because if you lost 10%, the drawdown effect would say if you lost 10, you only had to make back 11. And you did that pretty quickly. But how about for some of the less fortunate last year that didn't lose 10? Because I bet you any money, a lot of the people on here did not lose 10%. If they were listening to me, they probably did. But if they weren't, which most were not, because they didn't believe what I was saying was the truth, they probably only lost 30%. So a bunch of people lost 30%. Do you realize if you lost 30, you had to make back 43%? Folks, this is just math. This isn't me making this up. This isn't statistics. This is math. If you lose 30%, you have a 30% lower balance. That means that lower balance needs to work twice as hard almost, and it has to make 43%. So a lot of people last year, when they lost 30 and they were watching the markets come back and the markets got back and the news was like, oh my God, the stock market's back to where it was at its highest point. Do you guys remember that? It was all over the news. My gosh, everywhere in the news. Stock market makes new highs, beats the 2020 high point. Everybody's like, oh my God, this is amazing. And then you get your quarterly statement. You're like, that doesn't look amazing. Your statement didn't reflect what the news was saying. You're just like, well, wait a second. Hold on, honey. We lost 30% and we're still at a loss, but the markets are saying the markets are all back and they're higher than ever. Why are we not seeing that? It's called the drawdown effect. You lost 30, which means you had to make 43%, but you see some people didn't lose 30. Last year, and especially in 2008, any of you that are old enough to remember the Great Recession, some people lost 50. And you realize if you lose 50, you got to make 100% to get back the 50 that you lost. Do you all understand this? So what Stephen was talking about is one of the biggest risks being volatility. Do you understand that volatility is something that will keep most people from hitting the retirement goals that they want? Not because they're doing anything wrong, but because they're doing everything they've been taught to do right. Let me repeat that. You're not going to hit your goals because you're doing anything wrong. You're actually doing everything you've been taught to do your entire life, which is exactly why you are facing these headwinds. Everything right that you've been taught is all wrong. And it's wrong because they didn't teach you the right things to do. Holy crap, is a lot happening. Inflation is roaring. The markets are ping-ponging. The president keeps telling stories that the White House then contradicts. And the 5 and 30-year Treasury bonds inverted. And just yesterday, the 2-year and the 10-year Treasury bond inverted. I don't know what you guys are thinking, but I will tell you, this is a telltale sign that the recession is coming. Mark my words. Get your house in order and make sure you're ready.
As you're saying, the yield curves are inverting, and we can definitely get into that right now. You know, we'll see where that leads to. But if we look at, for instance, the 10 and the 2-year, which, Chris, I want you to explain this a little bit to everybody. But when you look at the 10 and 2-year, just to give you an example, since 1900, the 2 and the 10-year curves have inverted 28 times. And of those 28 times since the year 1900, 22 out of 28 times, a large recession has followed. So the indicators are starting to point towards a recession coming very, very soon.
Yeah, it's it's no longer a concern that you have your lazy cash like my cat here who just can't stay off the desk. Now it's a real concern of you better rush to protect what you've made. All that happens to create inflation is this dollar that I'm holding becomes worth less. And if you don't believe me on that, let me show you something to prove that. So for any of you listening, what I'm going to do is I'm going to pull up a chart here. And that chart that I'm going to pull up is going to show to you the US dollar, and it's going to show to you how much value the US dollar has lost over time.
And this should be a really compelling reason why you then start to conclude that the US dollar and inflation is there to weaken the value of your money. Because as they print money, the only place your money gets value from is, number one, the faith in the US government, but the US or the Fed reducing the value of your current dollars, if I said that right. So look at this. When the Fed was created in 1913, $100, this $100 bill that I'm holding, $100 was worth $100. Imagine that. That just seems logical, right? Fast forward to 2019. That same $100 and the buying power of that $100 is now $3.87. And that was 2019, prior to the pandemic. Now, they printed almost $5 trillion during the pandemic. So what do you think your dollars or your $100 bills purchasing power is? Well, the answer is less than $3.87 by history. So when you look at inflation, inflation is nothing more than a hidden tax if you really think about it. And many of you are brought to believe, because of the media and the false lies you're told, you are brought to believe that the government actually cares that inflation is going up. They want you to think that, but they don't. They want inflation to go up, because if you had debt valued at $100, okay, if you had debt that all your money was, your debts were valued at $100 in increments. So just take every single dollar was actually worth $1, and that's how your debt was created. But then imagine that dollar or $100 bill is now only worth $3.87. Wouldn't you love to pay back $100 with $3.87? Of course you would. All of you would pay all your debt off if you could pay every $100 of debt off with only $3.87. Does that make sense? Because that's what the government does. The government devalues your dollar by printing more of it. And the Fed is largely part of this, because the Fed thrives and survives on protecting the dollar and creating more debt. Because as they create more debt, okay, as the US government prints more treasury bonds, they then circulate those in the worldwide economy. China, Japan, all of them want US treasuries and they buy them. And then when they come due 10 years or 30 years, whether depending on which bond the country buys, let's just pick on China, when those bonds come due and they trade them in, let's just say those bonds were sold in, let's just say 1983. I'm just picking a bond. 1983, China bought a whole bunch of 30-year bonds. The dollar, $100, was valued at $9.94. That was the purchasing power of $100. Today, if China turned those bonds in, the US government could pay them back at a value of every $100 of only $3.87. It's the exact same thing. If you could pay every $100 of debt back at $3.87, you would love that. Therefore, the government loves inflation. So they will continue to print money. And the Fed will continue to aid them printing money because it is self-serving. And all of this printing results in what you see today, which is one of the biggest bubbles, speculative markets in history, only rivaled by the Great Depression bubble. 1929. But everybody's watching the markets today and they're saying, yeah, but Chris, even with the Russia-Ukraine war, the market's been doing okay. I'm making money. Well, of course it is. As long as they can print money, as long as they can keep playing this little thing, they will continue to manipulate the markets. Do you truly believe that when the Russia-Ukraine war started and the markets were down 800 points, but then they finished up 80 points, do you really believe that's because of real things? Do you really believe that that is not market manipulation? Because it is. Wake up, folks. This is one of the biggest games of smoke and mirrors, or whatever you want to call it. It is the biggest illusion in history. And you're part of the game. And you are also going to be the one that is going to lose if you don't pay attention and start taking action. Because we are in a super bubble, one of the few in history, where the stock market is at all-time highs and crazy valuations. Nothing seems to make sense. And it doesn't matter what index you look at. All of you that love, indexing. Oh my God, I hear this every freaking day and I just want to rip my hair out. Oh, I invest in the index. What index? Oh, I don't know. People don't even know what index they invest in. There isn't just one index. There's the NASDAQ, there's the Russell, there's the S&P, there's the Dow. Which index are you investing in? Oh, I'm sorry, you don't know because some jackass told you to invest in the index because the index over history has always made money, which is true. But you wouldn't probably hang on to that fragile, amazing index investment that you bought that you don't even understand. You wouldn't hang on to that if it dropped 30%. 40%, 50%, because you wouldn't be able to. Because when the market tanks, what else happens? People lose jobs. People get laid off. The value of their house goes down. The value of their 401k goes down. The value of their portfolio goes down. And when everything goes down, you don't feel so rich anymore. That's what happens, folks. And when you don't feel so rich anymore, or you're not rich anymore because all your money just evaporated overnight, and you're sitting there saying, oh my God, what happened? The same thing that has happened every other time in history happened, and it will happen again and again and again.
Bonds work very inversely to interest rates, and they work with supply and demand. So as more and more people get nervous about the markets. Now, when you talk about treasury bonds, who are the big players buying treasury bonds that change things? Other governments, China, Japan, institutions, hedge funds, insurance companies, they are the ones that really move the needle. So if the institutional investors, the hedge funds, the insurance companies, and the other countries get nervous that there's maybe a recession coming, what they will do is they will change their strategy from a short-term strategy, 2-year or 5-year, to a long-term strategy, 10-year to 30-year. Okay, so when we're looking at these bonds, the 2, the 10, the 30, those are durations, meaning if you bought a 2-year treasury bond, in 2 years it matures and you get all your money back. A 5-year matures in 5 years, a 10-year matures in 10, a 30-year matures in 30. You get the drift. So if you're playing the long game and you think that the markets are going to go down in the short run, because usually a recession or depression is usually a couple year thing. .com crash was 3 years. The Great Recession was a couple years. The pandemic was less than a year. So each one of them has a shorter term horizon, but it's usually very severe. It's usually very consequential if you've got money in the market. So institutions, what they will do is they will do what's called the flight to safety. They will take money from risky assets and move them into safe assets. Treasury bonds, safest asset you can pretty much put your money in because it's guaranteed by the full faith of the United States government, and they've never defaulted on a bond. So just so you understand that. So institutional money that normally would buy a 2 or a 5-year bond, short term, because they're then investing in riskier assets, all of a sudden gets a trigger or a sign, or their economists tell them, hey, we need to take a longer term approach because we think the market's going to go down in the next year, 2 years, or whatever it is. Instantly, they will shift their money to a longer term duration bond for the safety of it. And there's more to it. They understand the inverse relationship. They also understand that if the markets fall apart, interest rates by the Fed will get dropped, just like they have every other time. So if the Fed drops interest rates, the price of the bonds skyrockets. How many of you want to buy bonds when they're cheap and sell them when they're high, right? Isn't that what Warren Buffett says? Buy low, sell high, and don't lose money? Well, isn't that exactly what I just told you how to do? Treasury bonds are going down in price because interest rates are going up. So if you think that there's a recession coming and you're an institution, a hedge fund, and an insurance company, you're going to load up on the longest duration treasury bond you can because it's the safest bet and it's going to have the biggest move up when they drop interest rates, which is what these charts show. So now when all this money shifts from shorter term focus, 2 and the 10-year bonds, into longer term focus, which, if you were in a 2-year, you move to a 10. If you were in a 5-year, you might, or a 10-year, you might move to a 30. If all that money floats there, it changes the yield. And now you can get paid more money. I want you to listen to this, folks. And Stephen, then I'll have you put it up. I'm almost reciting what the article says.
It's good.
If you put money into a short-term bond, a 2-year or a 5-year treasury bond, you get paid a higher interest rate. They call it yield, a higher interest rate on that shorter term bond than you do on the longer term bond. Does that make any sense? Why would you make more taking a shorter duration versus taking a longer. Almost always, when you go with a 30-year or a 10-year bond, you get paid more for taking a longer duration, a longer time frame than you would taking shorter. But you see, that just inverted, which means the sentiment in the markets means that it's all going to fall apart because people are willing to accept a lower yield for a longer duration bond. If you don't understand that, I get it. I spent 16 years doing this bullshit on Wall Street, so we had to learn this in the Series 7 stockbroker exam. It was the number one thing we had to learn. It's like singed into my mind. But when I learned it, folks, I didn't understand it. Now I apply that information. I fully fucking understand it. And this is what the F happens. So that means you better understand this too. Because Stephen, how many times in history has this happened and how many times has it resulted in a recession?
Well, with the 10 and the 2, it's happened 28 times, and we've seen a recession 22 of those 28 times follow. So this is a chart. So this is a chart of the 2-year and the 10-year, the difference. So the yellow line that you see there is the 10-year minus the 2-year. So anytime it drops below that, that's when it inverts, basically. So you can see it led up right up in the 1980s. Wow. You see it happened back then, leading into that. 2001, the dot-com, 2008. It happened in 2019, but keep in mind, you know, we followed in 2020 with what we considered a recession, although it was a global pandemic. So a lot of people are saying this was leading towards, and then we printed all the money, and now we're just going back to what we delayed for a couple of years.
So folks, if listen, you could be a speculator and you could say this time is going to be different, and this time it's not going to lead to a recession like the few other times in history. But for me, I just like probabilities, right? And the probability given that both of these inverted yield curves have gone, within days of each other, the probability of a recession is far greater than the probability of it not being a recession. And let's just talk about real estate for a second. I am somewhat of a real estate expert. So what's going on right now? Well, since COVID and really, since 2008, Great Recession, but let's really just focus on since COVID happened in about March of 2020, and it happened a little before, but that's when most Americans remember the big hit. What happened? The Fed dropped rates. Rates are at historic lows, almost 0%. You can get a 30-year mortgage in the 2% range. That's phenomenal, and that stimulates a lot of people that want new homes. What else happened? We've been cooped up in our homes for well over a year now. Some of you cooped up more than others, but we've been cooped up, and we start seeing a lot of things we never really noticed in our homes because we're there so much. Maybe the house is a little too small. Maybe you're in an urban area and you're just like, I want to get away from people. I want to get out to those countrysides. There's a massive change in mindset and perception of people's living experiences and their homes. People are wanting bigger homes, and they can do that because of the low interest rates. But there is a severe lack of inventory. A lot of people that have homes don't want to sell their homes. They don't want people coming through. They don't want the hassle. Their fear of COVID is keeping people from listing their homes. So there is a massive demand for new housing, and there is a big shortage of new housing. Home builders can't build houses fast enough to support this need. So you have what I call a massive bubble forming, and that bubble is forming because of supply and demand. It's a very simple thing. Most of you learned this in grade school. When there is massive demand and a lack of supply, pricing goes up. And you're seeing the same thing happen for building supplies. Wood and building materials have gone up 30 to almost as much as 50%, depending on what you're looking at, from steel to wood, because of different problems that COVID has created. We can't get wood from Canada, which is a major supplier of wood in this country, because of the borders, because Canadians just they haven't really opened the borders up yet. So now all of a sudden you have a massive shortage, okay? And you have a big demand and a big supply problem driving pricing up. Now, a lot of people think that this is all inflation, which it is inflationary, but it is not inflation as the government wants it. The government is printing massive amounts of money trying to create inflation because we are not going to have an inflation problem. We are going to have a deflation problem, just like we did back in 1929, where the price of things are going to deflate. You know what? One good thing that's happening, but bad for the government, is people are saving more. Savings rates for the first time, and gosh, it might be, I don't even know how long it's been since savings rates have been there. And it might be different today, but we are above 10% in savings. People are saving money. Is it because of fear? Is it because they've just gotten a lot of extra money, whether it be unemployment benefits, whether it be stimulus checks? It doesn't matter. People are saving more money. So they're not spending as much because they're hopefully preparing. And the government is printing money in the efforts of, the hope that people are going to go out and spend and stimulate the economy. And that is happening in a roundabout way. So all these things create massive asset bubbles. There are giant bubbles in the real estate world, but people are ignoring it and thinking this is just going to keep going. As long as interest rates stay low, this is going to keep going. And maybe there's some truth to that. Other people are saying the stock market's just going to keep going up as they keep making credit easy and they keep printing more money. That's good for Wall Street. Wall Street's getting bailouts in some companies. There's so much going on that is stimulating all these, creating asset bubbles.
So the super bubble. The super bubble is real, and you are caught up in it. And when people ask me, well, yeah, this is great, but what should I do? I tell them it's very simple. Sell. Find a safe place to move your assets. If you love taking risk, then move your assets outside the United States. Look at international markets. Invest safely. Reduce the amount that you have in equities. Reduce the amount you have in risky assets. Change your strategies from a short-term strategy, or what we call get-rich-quick strategy, to a long-term strategy when it comes to real estate. Because if you're playing the short game in real estate, you're going to lose. But if you're playing the long game and you truly have the capital to play the long game, you could win, but it's going to take you a decade to get back where you're at. Don't believe me? Look at any other period, folks. If you bought a house in 2006 and 7, it took almost a decade to get the value of that house back, maybe even longer in certain parts of the country. Some people right now are still upside down from the houses that they bought in 2006 and 7, literally. So if those people are upside down and the market's at an all-time high, what does that tell you? Well, that tells you that back in 2006 and 7, we were also in a bubble and it deflated, just like this market bubble will deflate. And when it does, which could be very soon, because you're seeing a lot of signs right now, you're seeing all this, the telltale weaknesses that the market is ready to collapse. You're seeing things that don't make logical sense. You're seeing things happen in the markets that even the best of the best out there can't explain, and they just chalk it up to say we are at the end of a cycle. Things won't make sense until they all do. And what they mean by that is when they all do means when the market collapses. Folks, super bubbles can't last forever. They won't last forever. I can't tell you when and how or what's going to trigger this bubble, what's going to be the pin that pops the bubble. But I can tell you one thing with utmost certainty. It's coming. It's coming, and it's going to be bad. If you ask some of the utmost expert economists or hedge fund managers that have been in the game for a long time, when you watch their videos, you're like, wow, that guy's old. Yeah, he's wise. He's seen this before. When you watch them, they're all saying the same thing. They're saying this bubble's going to pop, unless they have some equitable reason to not say that, and they're just lying at that point. They all know. They know because of history and because of science. And because this event that we're in right now has happened to some extent somewhere else in history. Some of it looks very similar to 2006 and 7. Some of it looks incredibly similar to the dot-com crash. Some of it looks incredibly similar to the inflationary problems we had in the late 70s and early 80s. And I will tell you, the whole thing looks awfully similar to what we saw in the roaring 20s leading up to 1929. And the funny thing is, everybody keeps saying, yeah, but it keeps bouncing. The market keeps bouncing. Well, guess what? 1929, what is it that all of you know happened that year? That's right. That's the year the Great Depression started. But you realize that that year, the market had lots of rallies. The market would drop and then rally back up just like it is today. Exactly the same. And it was exactly the same in terms of why, because it was manipulation. Back then, it might have been the big bankers because they had all the money. The government wasn't doing what they're doing today because they didn't have the printing press in full steam. They hadn't figured that thing out, but they did print a lot of money. They did create a lot of debt. But that was also coupled in 1929 with big bankers dumping hordes of money into the markets to control it and manipulate it. And when they controlled and manipulated the markets, eventually that too came to an end. So what do we do? Well, if the Fed's number one job is to protect their greatest product, the dollar, well then don't try to beat that. If the dollar is the greatest product on earth, understand that, and then follow the big money. And I will tell you right now that the typical investment strategy that an advisor like what I used to be would be 60-40, 60% equities, 40% bonds. That model is gone because bonds are overpriced today. Equities are overpriced today. Even real estate's overpriced today. So where do you hide? Well, that's the tricky part. And I've got lots of other videos on this YouTube channel that tell you exactly where to go. But I simply want you to understand a couple things. The US dollar is the dollar used to trade crude oil. The US dollar and the Federal Reserve's job is to protect that dollar. Okay, I'm just reading some notes here. It is the best-selling product on earth. Everybody wants this. So this is the almighty. This is not trash. The dollar is not trash. You just are being brought to believe that it is because of inflation. But inflation will then give way to deflation. And deflation will benefit all of those who are ready for it. But it will harm all of those that thought cash is trash and that moved all their cash into risky assets like stocks and indexes and IULs and all these other things that everybody holds so near and dear because, oh my God, last year I made money, the year before I made money. Folks, you are living, or actually, let me rephrase that. You are driving your car, looking in the rearview mirror. Look out the front windshield because there's a big wall that you're about to hit. And the only reason you're about to hit that wall is not because you're not a good driver, but it's because you're driving, staring in the rearview mirror, the same way you are investing, staring in the rearview mirror. Look out the front windshield investing, and you will see the wall that you're about to hit. It's right there. It's not even hidden anymore. It's right out in the open. You can see it coming, but you're so busy and so caught up in that rearview mirror in past performance. In what you made last year and what you made the year before and how proud you are of yourself, and your little ego gets in the way and it puts blinders on you. And those blinders are going to ruin your financial future because this next one will more than likely be the next Great Depression. This next one will be a combination of so many things that make up the super bubble deflating and going down all at once. Folks, it will happen quickly. You probably will not have time to make connections or adjustments or corrections and adjustments in your portfolios. It's a shame because the only thing that's been really happening, if you really study at it, is the wealth divide in this country, the greatest country on earth, the United States of America, has widened. The top 1% or half of a percent have gotten incredibly wealthy. Wealthier is a better word. They have literally increased their worth and their wealth tremendously during the pandemic. When the average person probably, maybe they feel a little richer because their income went up, but they are no wealthier than they were before. The divide is getting bigger because everything that's going on benefits the wealthy.
Let's talk about your house and how much money it's worth today. It's gone up 30% since 2019. You're rolling. We're all rolling. We got all this money in equity in our house, and we brag about it. We go out there and we tell our friends, our family, our coworkers how much our house is worth. Some of us even go out and we take out home equity lines of credit. We put additions on, we put pools in, new kitchen, new bathroom. It's awesome. And we all wish it would just keep going up, right? But the Fed has a different plan for you. The equity in your house, whether it's actually in motion or sitting lazy on your couch, eating your potato chips, drinking your soda, watching your TV while you're out working for money, it really doesn't matter because all of that is about to go away. The equity in your house that you hold so dear to you is about to be taken away. Because the Federal Reserve is doing a good job of slowing the economy down, putting the brakes on the economy by raising interest rates 7 times in 2022, by unwinding the balance sheet, and by saying relentlessly that they will not stop until they get this under control. They want you to believe that they're actually super concerned about inflation, how much your groceries have gone up, how much the goods and services you buy have gone up, but that's not their concern. The Fed has to raise interest rates. Why? Because they know the economy and the markets are going to tank. And when they do, they need ammunition to fight that war. And what is that war? It's called a recession. A recession can also turn into a depression if not checked. So how does the Fed fight that? Turn the printing press on, drop interest rates to near zero. But if interest rates are already near zero, they got to get them up super fast. And getting them up super fast is slowing the economy down. Right now, June of 2022, we are seeing the brakes being put on. That's what the Fed's going to do to the economy. It's already happening, but they're just pumping the brakes. You see, when they do this and they slow the economy down and they suck liquidity out through the unwinding of the balance sheet, which is selling bonds in the open market, all of our assets that have been going up, up, and up, all start going down, down, and down. That includes the equity in your house is about to go on vacation, and that vacation is called gone. And when it does, you're going to wonder what happened. You're going to wonder why you didn't do something sooner. You're going to wonder why you didn't tap into that equity in your house, because once it's gone, and it's probably not coming back from vacation for at least a decade. How do I know this? Well, let's look at the past. Let's talk a little bit about what's happened in the past so that you can get a glimpse of what's next. You see, let's go back to 2008. We could go much further, but let's start there. In 2008, when the Great Recession took hold, yes, it was driven by real estate. Real estate prices fell significantly. There was a lot of risky driving going out there. Everybody's selling these mortgage-backed securities, these CMOs and GMOs, and whether you know what that is or not, doesn't matter. It brought the price of your house down significantly. And if you had had a line of credit back then, or equity in your house back then, in just about a year after the Great Recession started, the home equity line of credit that you had was frozen. The home equity line of credit that you wanted to get was nowhere to be found. The banks weren't lending. Are you getting some value from this video? If you are, click the subscribe button and smash that alerts button so that you're notified every time we do one of these videos to get you ready for what's coming. Let's talk a little bit about the pandemic. During the pandemic, this wasn't that long ago, banks started freezing lines of credit, home equity lines of credit. Banks stopped issuing home equity lines of credit in the fear that real estate prices might go down, in the fear that the markets might continue down, down, down. But then it didn't. It bounced. It went back up like a nice, pretty V. The Fed printed $5.1 trillion, traded it to the US government in exchange for government bonds, and everything went straight up. But now we're about to enter the next cycle, the downward cycle, the deflationary cycle, or maybe stagflation, and it's about to go straight down. It's already happening. I think we've had about 8 straight weeks of a declining market with only a couple up days. And those up days, we hold on to those so tightly.
Oh my God, the market's up. It's going to be okay. Should I buy? Should I start buying now that everything's going back up?
And then the next day, it goes down. And the next day, it comes up and then goes down. And the next day, it comes up and it goes down even more. It's an illusion, folks. It's going one place, and that's down. Because with what the Fed's doing, with raising interest rates and selling off bonds and sucking liquidity out, it can't go anywhere else. History proves it. So what about all that equity in your house? Let's talk specifically about that. During the pandemic, a bunch of wealthy people I know, incredibly wealthy people, got together and we all did meetings, much like this. And we talked about, what do we do? Well, it was a huge buying opportunity. Everything was down. Stocks were down, asset prices were down, housing was going down, everybody was scared. There was blood in the streets during the pandemic, definitely blood in the streets during the Great Recession, and it was a massive buying opportunity. But the only people that could buy were the people that had access to capital. So here's what we did to make sure that all that money in our houses didn't evaporate if the thing should break loose. We went to all the banks where we had lines of credit and we pulled all that money back out. That's right, we took the max loans from our lines of credit. The money came from the line of credit and went into the bank account associated with that line of credit. Then what we did is we took the money out of that bank and we moved it into another bank. We took some out of that bank and we moved it into another bank. We took some out of that bank and we put it in our private banking policies, those specially designed and engineered whole life you always hear me talking about. Then we took some of that and we put it in another one of those private banks. You see, we played the cup game. We had all this money that was all money that was in lines of credit. We took that money out and we moved that money into different banks in different banking systems, so that when that bank that issued that line of credit said, hey, we want our money back, I was like, I don't know where it is. Is it under this cup? Nope. Under this cup, you play the shell game. You start moving the money around. You just keep moving around. Is the rabbit under this one? Nope, not under that one. Under this one? Nope, not under that one. You guys have seen that with magicians before. Well, myself and a bunch of my wealthy friends played that same game with money during the pandemic. But then what happened? Well, everything started going back up. So we no longer needed to play the cup game. So we took the money back out of the investments, which had gone up in price, and we paid off all the lines of credit. Business as usual. No interest owed back to the banks. But now, here we are again. June 2022, you're already seeing the price of real estate come down off of its highs. You're already seeing builders slow down the amount that they're building. You're already seeing pricing start to adjust a little because of supply and demand. You know what's next for you? Your house is losing value right now. While you sleep at night dreaming of little sheep jumping over the fence, your house is losing value. And as your house loses value, you have access to less and less and less money. And that will start to go faster and faster. Think of dominoes. When you push the first domino over, it all goes quick. Well, that's how it's all going to go here. How long are you going to wait? You're going to wait till it's all gone? You're going to wait till all that equity in your house is gone? No, you're not. You're going to take some action. You're going to do what we did back in the pandemic. You're going to get your house in order. You're going to get your money in order. You're not going to let them just freeze your lines of credit, are you? No. So let's talk about some action steps for you. You don't want to lose the equity in your house. Nobody does. But that requires you to take some steps right now. Do you have a home equity line of credit already? Oh, you don't. Well, now is time to get one. And if you don't get one, you won't be able to get one. How about that?
How about that?
So it's kind of a use it or lose it kind of scenario. So rush over to your bank, credit union, community bank, and apply for a home equity line of credit. They will gladly give you up to 80% of the equity of your house. And as long as you've got that, let's get that money available. Because how much money does it cost to get a home equity line of credit? Zero in most cases. Usually the bank will even pay for the appraisal. It costs you zero money if you don't use that. So if you get the home equity line of credit and they issue you a home equity line for, let's just say, $50,000, that 50 grand costs you nothing until you take that money out. And we're not going to quite take it yet. We're going to wait for a little more blood in the streets. We're going to wait for this thing to go down because we've already got the home equity line issued and we've got that money sitting in that line of credit, but that doesn't mean your money's protected because at any time that bank can freeze that line of credit. And you want to be ready to take that money out of that home equity line of credit or that line of credit and use that money to make money. So as you start seeing things deteriorate, this is the hardest part. When you take the loan from the line of credit, when you take that money out, the interest starts to tick away. And now all of a sudden they're charging you interest on that money. So what we want to do is we need to very quickly get that money working for you. I do it by lending money out at a higher rate. You might be able to do it by taking that home equity line of credit and paying off the credit cards that you currently have, taking the money you're paying the credit cards and then put that money back into the line of credit. You see, if the money's not in the line of credit and the money's not sitting in the same bank that the line of credit is in, then they can't take the money back. Revert back to the story of the cup game. You take a little bit of money from your line of credit, you move it to a different bank, a line of credit goes to a community bank, a credit union, or maybe you set up one of those privatized banking policies. Companies like Quantum RE, which is one that comes top of mind, they'll give you the equity in your house and they won't charge you any interest on that money. They won't make you make monthly payments, and they won't dive deep into your credit score like the banks do. So if you can't qualify through a bank, maybe you should look into a company like Quantum RE, because they'll give you the equity, and what they're gonna do is share in the future appreciation of your house. But if you think your house is gonna depreciate, they also will share in the future depreciation, but they give you your equity, your money today. Check them out, quantumre.com. And then all you do is, after everything starts to fall apart and there's blood in the streets, now you start to deploy that capital. You start to go out there and buy assets when they're off of their highs, when they're 30, 40, 50% lower. Some of those assets could be stocks, mutual funds, ETFs. Some of those assets could be real estate, apartment buildings, storage centers. It will all go on sale, folks. The question is will you have the cash to buy it? Because today you do. You've got equity in your house. All your assets are bubbled. Get out. Get access to that cash and get ready to deploy that money for one of the biggest buying opportunities of your life. But if you're not ready for it, it's going to be one of the worst periods of time for your financial future.
See, you all think that inflation means that milk and crackers and cookies and pizza and gas all just goes up in price. No, no, no. You see, that's only a small piece of the equation. Really, what's happening is inflation is a hidden tax.
No shit, that's interesting.
Inflation is a way for the government to ruin the value of your money, to steal your money by devaluing the dollar. Now, why would the government want your dollars to be worth less? Well, it's very simple to understand. Let's just assume that you owe $10,000 to Visa, and Visa's charging you 29%. What if Visa went to you and said, listen, you owe us $10,000, but if right now you pay us $5,000, we're good. Would you not find $5,000 to pay them? You would. So what does the government do? By the government devaluing your dollars, the government gets to pay back all of its debt at a lower value. Doesn't that make sense? Because all of us want to pay our debts back at half or 25% of its current value, so that's what printing money does. Devalues the dollar and allows them to pay it back. But let's come back to Bitcoin. And in doing all this, when the dollar is going down in value, people don't want dollars. They want to find something more valuable, something like Bitcoin, the new dollar, the new money, or whatever you want to call it. It's just a store of value. People find value in what Bitcoin does because it's a finite amount of it. It has the potential to be money, which is nothing more than a means of exchange. And because of that, investor confidence drove the price up, and away. How high? Well, it got into the mid $60,000 range. Actually, I think it was the high $60,000 range. And then all of a sudden, poof, just recently, it free fell. Down, down, down. Let me ask you, were you buying when it was 40, 50, 60,000 because it felt good? Because FOMO kicked in?
Oh my God, I'm missing out. It's gonna go to 120. It's going to the moon.
Or were you being cautious and selling? Because I'll tell you, I sold. I bought at the lower prices and I sold when it got higher. And I just kept doing this over and over again. But recently, when it fell down to 28,000, I started buying a whole bunch. And all of you should have been buying a whole bunch because you know what? Bitcoin and Ethereum and all the other coins dropped significantly in value. And now they're on the way back up. So when we talk about the Great Reset, is Bitcoin the almighty? Is Ethereum the almighty? Is crypto where your money should be? Well, if you understand it, you understand the problem it solves, but you also understand the risks it holds. It's a very volatile asset class, driven solely by investor confidence with no fundamental and no intrinsic value. So when you talk to investors like Warren Buffett or guys that trade on fundamentals, they say no way to cryptocurrencies. They say no way to Bitcoin, no way to Ethereum. There is no intrinsic value, so we have no idea how to determine what the value in the future will be, except for somebody speculating, saying it's going to the moon. So when you buy Bitcoin and Ethereum, what are you really buying? Are you buying currency? Are you buying a store of value? Are you buying money? Well, you are not buying money because money is a means of exchange. And as of right now, in most countries, money is what they print. It is the only legal tender. In the US, it's these greenbacks. This is the only legal tender that we can exchange. But you see, Bitcoin, you can't. Now, I know early on, Elon Musk said, hey, we will accept Bitcoin as a form of payment for Teslas. Then he, for some reason, said, oh, Bitcoin's bad for the environment. We're no longer going to accept Bitcoin to pay for your Tesla. You see, that is not a good means of exchange. One day you can buy a Tesla, the next day you cannot. And one day Bitcoin is at $60-some thousand, and the next day it's at $28,000. Is that how you want your currency to react? No. You want your currency to be stable. Bitcoin or cryptocurrencies are not that yet. But what's next? What might happen? Well, if you talk about Davos and the Great Reset and you look at everything happening and you really take a look at what's happening to China. China banned mining. So you can't mine for Bitcoin or Ethereum in China. They put the stop to it. I know people from China and they had big mining operations that just got shut down. So they brought all that over here to the US. But now what's happening in the US? Well, they're talking about an executive order. What does this executive order mean? And is that already built into the price of Bitcoin and Ethereum today? Well, I don't know. But it is definitely something to look at because it could drop the price back down again. See, right now we're fighting to get over this $38,000 level, and it's a strong level. We may hit that and just bounce right back down to 28, or we might run through it. It's anyone's ballgame because it's all based on investor confidence. And if the executive orders come out and they're saying it's going to be February 2022, they're going to announce this, we have to sit back and decide, is it going to drive Bitcoin up because there's a finite amount, or is it going to drive it back down? The best way to invest in any of these is the same way that you should be investing in any type of a stock, a mutual fund, an ETF, and that's called dollar cost averaging. Depending on where you buy your cryptocurrency, you should be setting it up so that every single week or bi-weekly or monthly, you're buying a little bit. Like I do it, and I take $100 every single week and I put it into Bitcoin, and I take $100 every single week and I put it into Ethereum. No matter where the price is at, I'm always buying. And then when the price drops, like it just did, I take big chunks of cash, and then I take these big chunks and I say, ooh, I'm gonna buy a big chunk of Ethereum, I'm gonna buy a big chunk of Bitcoin. Now you'll notice I'm not talking about the shit coins. Not talking about those coins that are 0.000018 to buy. And all of you think, oh my God, I can own twice as many or 100x or 1,000x of those versus buying like a fractional share of Bitcoin. You think that more is better because you have bought into FOMO, the fear of missing out. You think that that coin, if it just goes up 1 cent, you're gonna be a millionaire. But 1 cent up is the same as 1 cent down, and 1 cent down means you're broke as shit.
I'm broke as a joke.
So do you want to play that game? You shouldn't, because the mathematics are the same. If you buy a fractional share of Bitcoin, okay, even though you own a minute, tiny little amount of one coin, and then you go out and you buy millions of shares of a shit coin, and you think just because you have more, you're going to make more money. That is not it. The math is the same. Depending on the way that they move, doesn't matter how many shares you own, you make the same percentage. You just think that because of speculating and because of your confidence that that shitcoin is going to make you a multimillionaire, and maybe it will, or maybe you'll go broke. So when we talk about the Great Reset, you really need to get ready for it because it's coming. And one final thing to tell you that it's coming is the Fed minutes. Not only did they say they're going to raise interest rates, we already talked about that, but they also said they're going to do what? They're going to taper the bond purchases. You see, the government has been selling bonds to the Fed at a crazy amount, billions and billions of dollars a month. tens of billions for that matter, and they're going to start tapering that back. They're going to start slowing that down, which what that's going to mean is all this liquidity that we see, all these riches that you see in the markets, everybody's got access to lots of money. That's going to start to diminish. Then what the Fed will start to do is sell their bonds in the open markets, and that will suck, literally suck the liquidity out of the markets, making it so that you can't get easy money. And it will also be paired up with rising interest rates, making it more expensive for you to go out and do the things you're doing today. And then eventually it will stop. The economy will flip. We will go into deleveraging. Eventually inflation will give way to deflation, and boom, we are into the next cycle, and you won't like that one. So how does Bitcoin play into that? It might be a good position to have, but I wouldn't go all in on it just yet.